what Bill Ackman taught me about business acquisitions. So the first thing, and actually the only thing that Bill Ackman taught me, because he's a student of Warren Buffett, Charlie Munger, Peter Lynch, is that you need to be an activist investor. So what that means is that when you buy a business, then you need to provide great principles, business principles, and corporate governance to a business. When you provide that to a business, then it will only increase not only the value of the business, but also the chance of it succeeding in the long term. So when you buy most of these businesses, they don't have any corporate governance. It's very rare. It's only medium-sized businesses and above that have corporate governance principles. So if you're buying a small business which is classified as a business doing less than £10 million or $10 million in revenue, then you provide the corporate governance of that business. And you provide some of the standard operating procedures which standardize practices across the company. When you do that, it's only going to improve the performance of the business, but also make it risk-free, or at least reduce the risk. Because if you have key employees that end up leaving, then your standard operating practices and your corporate governance that you provide is going to be the safety net of that business. So Bill Ackman always talks about long-term prospects, and he also talks about the balance sheet of the business being strong, that you don't have to access outside capital to go and operate the business or continue to operate the business. If a business itself can provide capital to its own growth, that is the ideal situation. Now for really small businesses, it's actually difficult to do that, but at least if the debt service coverage ratio, and that's why I adapt Bill Ackman's teachings, of course, in the value acquisition, is that if, for example, the debt service coverage ratio and it has a strong margin of safety, a very strong free cash flow element, even after debt service coverage ratio, then the business can continue to provide investment for itself, or at least raise investment to ensure that you can grow that business. But it's ultimately your changes, your mind, your advice to that business which is going to take it to the next level. Remember, when you're buying small to medium-sized businesses, they're small to medium-sized businesses. You can go in and you can make a difference to those businesses by providing that advice, by providing that management guidance to the managers, by providing your expertise as an investor. For example, I'll give you one right now. When people do marketing, then what they focus on is ROAS, which is return on ad spend. And they normally peg that against revenue, which is completely incorrect. What you need to peg that against is gross profit. It's only if your gross profit is giving you a return on your ad spend is that going to be a successful future growth. So things like these are what you need to go and input into the business acquisition that you buy. And that's why Bill Ackman's principle of being an activist investor is so important, that you go in, you look at the business that you've bought, and it's already a fantastic business. Remember, we only go over in the value acquisition, we only go for businesses in the top 30% to start off with, and then later on 25% and top 20% of businesses within the industry into the small to medium business space. We only go after the best businesses, but we can improve them even further. So if you want to find out more about value acquisitions, then watch this video which is popping up on the screen right now. And of course, there's a link in the description in which you can click that and get the full training on the value acquisition.